Welcome to the Company Value Investor channel. In today's video, we are going to analyze the IBM company. International Business Machines. Okay. There we go. Now, the reason why I want to analyze IBM is because today they made news. Their stock went up almost 13 points. Currently, the IBM stock is $159.53. Okay, let's recap a little bit. For the average investor, think of the current price as your FICO score. It goes up and down depending on whether you meet all your obligations, you pay everything on time. Just consider that as your FICO score. The rate needed for IBM is 8.6. Think of this as your credit card interest that you pay on a monthly or whatever, on a monthly basis. The amount expected, this is the amount of capital that the IBM needs to make in order to meet its obligations. For the average investor, think of this as the amount you need to make your monthly or yearly payments. Number 3 is amount made. This is IBM's real earnings, not the net profits, but their real earnings. The investor should consider this something like the amount you actually made after you paid everything. That's what you left over. And the last thing is the amount needed. This is the amount of capital that IBM needs in order to maintain its current operations. For the average investor, think of this, number 4, as the amount you need in order to maintain your current or your lifestyle that you wish to have. And with that being said, let's analyze IBM. Okay, IBM 2016. In 2016, it is an average stock. The stock is undervalued and it is a very profitable corporation. Why is it an average stock? Well, first of all, its earnings per share are 11.9. Its price to book ratio is 8, almost 9, and the retained earnings is a low 56%. Basically, when you combine everything together, the earnings per share and the price to book ratio and the retained earnings, that makes the stock what it is. It's either a weak, strong, or average. Right now, the IBM stock is average. It is also undervalued, and the reason why it's undervalued is because right now it's at 159 when it should be around 170, 180. Only because in 2016 they had a they had a substantial amount of cash flows. 2015 they had negative cash flows, and the reason being is because they spent half of their money that they made from operations, or half of their money investing and financing. 2014 they also had negative cash flows. Again, most of their money, or half of their money, went into financing activities. And in 2013, they had positive cash flows. The only problem I see is that in 2014, the negative cash flows was very large. It was substantially larger than all 3 other years combined. So with that being said, let's analyze IBM for 2015. Again, average stock, undervalued stock, and profitable. And the way that you know it's a profitable company is the real earnings is positive and the amount expected is positive, and they've also had more than enough capital to meet their operations. So that's a good thing. Having all 3 positives is a good thing. Now remember this. They only need to make an 8%, 8.1% on their internal rate. Basically what that means is that in order for them to meet the expectations of the owners or the creditors, they need to make 8%. And in 2015 and 2016, they surpassed that. Let's try 2014. Again, now it's 7%, positive here, positive all around. It is a very good, profitable company, even though the stock is average. And the reason why the stock is average is because a company that's average, they retain anywhere between 40 to 70% of the retained earnings. A company that is above average, they have a good earnings per share, a good price to book ratio, and they retain a lot of their capital, or a lot of their earnings. Now let's go to 2013. In 2013, the stock was strong. It was undervalued, and it was still a profitable corporation. So overall, the company IBM is a good company. It is very profitable, and the stock is undervalued. Going back to 2016. Now, the only reason why 2014, let me go back to 2014. No, it's a good year too. Okay, now that we know that IBM is a good company and a profitable company, let's take it a step further. Let's invest $10,000 today and see how much we'll make at the end of 1 year. So if I was to invest $10,000 today, I would make approximately a little over $800 in 2018. In 1 year, I would make about a little more than $800. That puts me at an interest rate of about a little over 8%. That is very doable. The reason why I know that is because IBM, they average anywhere between 8 and 10%. So I know that I can make my 8, 9, 10% if I was to invest $10,000. If I invest $5,000, my profit goes down to a little over $200, an interest rate of about 4%. It's a good company at $10,000, but at $5,000 or lower, the interest rate or the profit is small. So I think $10,000, it's within the range of IBM where I can maximize my profit. If I go to say $20,000, if I invest $20,000 today, I will make a profit of about $3,000 by the end of 1 year. However, in order for me to make that profit, IBM would have to earn a 16% on the interest. And the reality is, I don't think they're going to be able to make 16%. On average, they meet their percentage. On average, they'll make about 8 to 10%. 16%, 17%, I don't think they're able to do this. So if I was to invest in IBM, it would be for $10,000. At the end of 1 year, I would make a little over $800 at an interest rate of about 8%. So to recap everything, the question is, would I invest in IBM? The answer is yes. Yes, I would invest in IBM. However, IBM does not meet my criteria of earning a 20% on my investment. They do, however, provide a good profit if I invest $10,000. For 1 year, I would get a little over $800, earning an interest of about 8%. So overall, IBM is a good company, and I would invest in this corporation. Again, thank you for the time. I hope the video and the analysis helped you. If you have any questions, put them in the comments or email me. I'll be more than happy to answer. As always, keep investing.